Fusion Mobile, quality e-learning experience on the go.
You are welcome to Fusion Mobile e-learning platform. I'm Olokobi Pelumi by name, the accounting tutor, and this class will be treating Goodwill and evaluation accounts. So we'll be looking at the meaning of Goodwill, reasons for Goodwill, okay, types of Goodwill, Goodwill valuation, and the meaning of evaluation, and entries in the books of account. Now, firstly, we want to look at the meaning of Goodwill. Goodwill in the book of the partnership, or Goodwill in the book of the company, and Goodwill in general aspect of business. What brought about the word Goodwill? So there are a lot of reasons that brought about the word Goodwill. So Goodwill may arise as a result of good management and name and reputation of the business organization. So an organization that has been in existence for a long period of time will enjoy the word Goodwill, because such an organization will have a change in management, will have good management, will have built good reputation, and have built good business name. So that means the value of money, the amount of money or amount of capital in which the owner of the business uses in starting the business then will not be equal to when the business is to be sold in the next period. So the difference between the capital, like the net asset of the business, and the purchase of the business when the business is to be sold, that's what we terms as Goodwill. So when talking about the word Goodwill, Goodwill is always defined as the essence of purchase, as the essence of net purchase consideration over the net assets of the business, and it is given to the owner of the business, that is the vendor of the business, the person that is selling the business during the period, and it is to be paid by the purchaser of the business to the owner or the vendor of the business. So when talking about Goodwill, we have defined the word Goodwill as the essence of purchase consideration over the net assets, which is to be received by the vendor of the business and to be paid by the purchaser of the business. So generally, Goodwill arises as a result of good management, good location, and a result of good name and reputation. So, and also as a result of long existence. A business that is starting now will not have the same Goodwill as a business that has been in existence over 20 years. Although they might be in the same line of business, but that reputation will be there, that name will be there, because the name, reputation will have been built by the business. So they will not be equal in value, because of there must be a change and reputation in the old business. So when the business is to be sold, Goodwill will arise, and it's not only when the business is to be sold. Goodwill can also arise in form of partnership also. Now let's look at the reasons for Goodwill. There's a lot of reasons. I've said some reasons why giving some explanation. That is what brought about the word Goodwill in business. Number one can be as a result of good location, as a result of name, reputation can also brought about the word Goodwill in business. What can also brought about Goodwill might be as a result of good quality of products being produced by such an organization. An organization that is known for good quality of product will have good reputation by customer, and that actually will attract a lot of Goodwill to the business. And again, what can also brought about Goodwill can be as a result of manager screens. The skills that is very scarce to have, and a business organization can have such skills. So that can actually bring about a very good way to the business organization. And a lot of another reasons we can also have Goodwill in the business. Okay, let me write it down. Number one, we talk about location, good location. We talk about the name, and we talk about the reputation of the business. And next, we talk about quality of products, and the organization producing quality products. We actually enjoyed Goodwill in the business. We talk about the name, location, and we also talk about the managerial screen. Manager screens in the business. So we talk about the quality of products, location, name, reputation. Also we talk about the manager screens. That a business that have good manager screen will actually enjoy the word goodwill. Now let's talk about the types of goodwill. We have different types of goodwills. Basically, we have two major types. We have one, we have the purchase goodwill, and we have the two. We have the inherit goodwill. So the purchase goodwill, this type of goodwill arises when the business is to be sold. So if the business is to be sold out, what will happen? A purchase goodwill will arise. So that means the purchaser will have to pay for the goodwill is to enjoy it while coming into the business. So purchase goodwill arises when there's an acquisition of a new business. The next one we have is the inherit goodwill. This type of goodwill is inherited by what? By an organization itself, that it is earned by the organization itself. So that means as a result of maybe good management, as we give what reasons for goodwill, or as a result of what quality of product, as a result of managerial screen. So that can also brought about what goodwill. The organization can build that as a result of this reason. The organization have a perfect location for its business. When the business will be sold, what will happen? Or we also have a very good value for its goodwill. Name of the organization can also attract goodwill, and also reputation. Quality of product, if it's of a good quality, that can also attract goodwill. Manager screens too can also attract goodwill into the business. So inherit goodwill is actually what built by the organization itself, that it is earned by the organization itself. So now we have goodwill valuations. We have different methods used in valuing goodwill. Different methods have been in existence for valuing goodwill. So we have different methods of valuing goodwill. We have number one, we have the supernormal profits, or super profit. So number two, we have the normal profit. We have the supernormal profit. Number two, we have the average profit. Then number three, we have the weighted average profit. A lot have been based on the school of thought. Weighted average profit. Number four, we have capitalization method. Different methods of valuing goodwill. Capitalization method, and so on and so forth. So we're not going to look at this calculation aspect because this is about an advanced level. So this is an advanced level. When we look at the calculation, when we look at the supernormal profit, so you can just keep this yourself. Although it's not in the WAEC syllabus and JAMB syllabus, also in the NECO syllabus, you can have this. So you can just know it now. But when you get to an advanced level, you have difficulty. So we have the supernormal profit, we have the average profit, we have the weighted average profit, we also have the capitalization method. So let's move to the meaning of evaluation. Okay, let's talk about change in partnership. What brought about change in partnership in business? It's also important we talk about change in partnership before we move to evaluation. What can brought about the change in partnership form of business? So what can brought about change in partnership? Because when there is a change in partnership, what will happen? There will be an existence of goodwill in the partnership form of business. So what brought about change in partnership? Maybe one, admission of new partner. So if there's an admission of new partner in the business, so if there's admission of new partner into the business, into the partnership form of business, what will happen? The new partner will have to pay somewhat, so amount of goodwill to the existing partner. So you have to pay for the goodwill is to enjoy in the business as a result of good management, accelerated locations. So what will happen? You have to come and enjoy some aspect of goodwill that have been built by the former partner. So while coming to the business, you have to come and pay for the goodwill. So that is what that aspect is actually telling us. So admission of partner, we call for goodwill, and that is the change in partnership. Number two, change in sharing profit ratio. change in sharing profit ratio also. That will also brought about what? Goodwill. We also have 3 dissolution of partnership. Okay, so dissolution of partnership can also brought about change in partnership within the period. And next we have when a partner retires or die. So when a partner retires or dies, that also brought about change in what? In partnership. And once there is a change in partnership, what will happen? That will cut for what? Goodwill. That is, the goodwill will be introduced into the what? Into the book. So let's look at the accounting entry when goodwill is introduced. When goodwill is introduced into the book. So accounting entry. So if goodwill is introduced, that's introduction of goodwill. So introduction of goodwill into the business. So first thing we are going to do once there's an introduction of goodwill into the business is for us to debit goodwill account. So we are going to open an account called goodwill to debit goodwill account. So what are we going to do again? Credit capital account. Credit capital account of partners. That is the old partners, and that will be in their what? In their old sharing profit ratio. In their old sharing profit ratio. So what are we going to do? We are going to introduce what? Introduction of goodwill. We are going to, by introducing goodwill, involves debiting goodwill account and crediting capital account that is of existing partners. We credit the capital account of what? Of existing partner. What are we going to do? We are going to credit that in their old sharing profit ratio. Now the next thing is if goodwill is to be written off. So partner can agree, okay, we don't want goodwill to be retained in the business. They can decide to retain the goodwill. If goodwill is being retained, it should be in this form. And if they decide to write goodwill off, goodwill can be written off within the period. So if goodwill is written off, the goodwill written off. So if goodwill is written off, so what are we going to do? That will be the reverse process of this. We are going to debit the capital accounts of partners, of all partners, both the new and the old. What are we going to do again? We are going to credit the goodwill account. Goodwill account. So what will happen? Goodwill will be cancelled. So in what ratio are we going to do that? In their new sharing ratio, profit ratio. Because once there's a change in partnership, what will happen? There will be a change in sharing profit ratio. If there's a new partners in the business, what we are admission of a new partner in the business, change in profit ratio will change, and goodwill will have to be introduced, and there will be a change in in profit ratio. The partner can decide themselves, let's change our share of profits. So once there is a change in the sharing profit ratio of partners, what will happen? Goodwill will be brought. And what are we going to do? We are going to introduce goodwill into the business, into the book, and we are going to debit goodwill account and credit capital account of partners. And if it is to be written off, what are we going to do? We are going to credit goodwill account and debit partner capital account. And now in their new sharing profit ratio. That is when goodwill is to be written off and when to be introduced into the business. Now let's go over to evaluation account. So when talking about the evaluation account, we're talking about the goodwill. So once there is a change in partners, what will happen? The partner can decide themselves, okay, let's make an adjustment in the value of an asset in order to ensure that the asset reflects current economic values. So if there's a change in partner in the partnership, the partner can decide themselves, okay, since there's a change in partnership, what will happen? There must have been a change in some value of some assets. So in order to ensure that, okay, the asset of the business actually reflects current economic values. So what will happen? There will be an adjustment in the value. So the adjustment that will be reversed to as what? Revaluation. And that such a revaluation will be made by an expert in the business. So once there's a revaluation in the business, that will also call for goodwill. So let's look at evaluation in the book of account. Okay, what calls for evaluation? What can call for evaluation is when there is change in partnership. Number one, when there is admission of new partners, when there is a change in the what? In the sharing profit ratio of the partner. And when the partner dies or retire, what will happen? There will be a revaluation in the value of the asset. Let's look at so we can look at the book of account, how we are to record evaluation in the book of account. Number one, revaluation. We are going to debit and credit. So we are going to debit evaluation account. We are going to credit evaluation account and debit evaluation account and credit asset account. We are going to what? Credit assets account with deduction in the value of asset. With reduction in the value of asset. That is, if there is a reduction in the value of asset within the period, so the accounting entry is for us to what? To debit evaluation account and credit asset account within the period. So that will be the evaluation reduction in the value of the asset. Maybe the value of the asset before is actually 500 naira in the book, so we have to revalue it by 300 naira. What are we going to do? That is very simple. So that is the differences. There is a reduction now. This is the old value and this is the new value now. This is the old value, this is the new economic value. So there is a reduction in the value of the asset. So and that reduction is actually 200. So what are we going to do? We take 200 naira to do what? To the credit side of the asset account, and we take what? Evaluation to the what? We take the what? The 200 naira to the revaluation account, to the credit debit side of the revaluation account. Now, the next entry is we have to debit and credit. So we are going to credit asset account and credit. We are going to debit asset account and credit revaluation account. That is the accounting entries on under revaluation with increase in the value of an asset. So where is that there's an increase in the value of an asset, that is the accounting entry. We are going to debit asset account and credit evaluation account within a period. We are going to what? We are going to debit asset account and credit evaluation accounts within a period. Now 3, we have debit and we have to credit. So we are going to debit evaluation account and debit liability account and credit liabilities account with the increase in liability, increase in the value of liabilities within the period. So once there is an increase in liability in the period, we are going to debit evaluation account, and what happens? We are going to credit liabilities account within the period, and that represents the increase in the value of liabilities within the period. So once there's an increase in the value of liability, what are we going to do? Carry out what? The entries. Now the next thing, now we have number 4, which is we are going to debit and we are going to credit. So once we have we are going to debit liabilities account, which is the reverse process. When we have just the reverse process, and we are going to what? Credit evaluation account, with the decrease or reduction, anyone, in the value of liabilities. Once there's a decrease in the value of liabilities, we are going to what? We are going to debit liabilities account and what? Credit evaluation account. Then number 5, when goodwill is what? Is introduced in the book. When the goodwill is introduced in the book, we've explained that already. What are we going to do? We are going to debit goodwill account. We've done that already. Debit goodwill account. When goodwill is introduced in the book, debit goodwill accounts and what? Credit capital account of partners. That is introduction of goodwill. This represents the introduction of goodwill in the business. When there's an introduction of goodwill in the business, the number 6, we have to debit and credit capital accounts of partner and what? Credit goodwill of partners. So when goodwill is written off of goodwill, so written off of goodwill in the business, or goodwill written off within the period. Now let's talk about 7, that is share of profit, debits and credits. When there is profit on evaluation, we are going to what? Debit evaluation account and credit partners capital accounts. Capital account with profit on revaluation. So now number 8, we are going to debit and credit capital account of partners and credit what? Evaluation accounts with loss on the revaluation. So that is all about the accounting entry. So it's an interesting process that have to be known of. And so we have our number 1, we have to debit evaluation account and credit asset account with reduction in the value of assets. Number 2, we have to debit asset account and credit evaluation account with increase in the value of what? Assets. And number 3, we have to debit evaluation account and credit liabilities account with increase in the value of liabilities. And number 4, we debit liabilities account and credit evaluation account with reduction in the value of what? Liabilities. And number 5, we debit goodwill account and credit capital account with introduction of goodwill into the business. And number 6, debit capital account, credit goodwill account, which when goodwill is being written off in the business. And number 7, we have debit evaluation account and credit capital account with profit on evaluation. And number 8, we have debit capital account and credit evaluation account with loss on revaluation. Okay, we have an illustration on evaluation of partnership, that is evaluation account. Solo and Ojo are partnership sharing profit and losses equally. And 1st January 1995, they decided to admit Ojo. So with the admission of Ojo, there will be a change in partnership as stated earlier. So who would be entitled to 1/4 of any future profits? So his own sharing profit will be 1/4 of any share of profit in the future. And again, the balance be shared equally between Shola and Ojo. The financial position of the business before the admission of Joke was as follows. Now we have freehold premises. We have 375,000 naira. This is the financial position of the organization before the admission of Joke in the business. We have features and fittings. We have stock in trade. We have debtors, we have cash, and also we have the creditors within the period. So we are given some additional information as regards to the question. So the first one we have, it is agreed to value everything goodwill at 30,000 naira. As stated earlier, that once the admission of new partners, the old partners has to pay the existing partners some certain amount of what goodwill is to enjoy while coming to the partnership. So it's to pay goodwill of what 30,000 naira to the existing partnership. And again, we have revalued the other asset. Right? We said that some value of the asset will be revalued within the period in order to reflect the current economic value of such an asset. Now, freehold premises were being valued as 100,000 naira. At least there is an increase in the value of what freehold premises. So we have fixtures and premises also. Okay, that should have been fittings. That's an error. Okay, we have fixtures and fittings. Okay, it was value at 24,000 naira. That's a reduction in value. Then the next one, we have stock 103,000 naira. Also reduction in what? In value. Now we have to make provision for bad debts of 3,000 naira is made. Provision of bad debt of 3,000 naira is made in the book. Now capital is contributed by Shola and Ojo equally. The capital is contributed by them equally in the business. Joke is to bring 80,000 naira into the business as capital. Joke is asked to bring 80,000 naira into the business as capital. While also is also going to pay for what? For 30,000 naira as goodwill. Okay, we see that the capital is contributed by Shola Ojo is always what? Is equal. And we are asked to prepare valuation account. We are asked to prepare the partner capital account. We are asked to prepare the opening balance sheet of the new partnership of Shola, Ojo, and Joke. And we have been given the accounting entry before, so that's what we are going to debit and credit. But the first thing we should prepare now, before preparing our evaluation account, is to prepare the opening balance sheet of Joke and Solo. Okay, that is their closing balance sheet before the existence of the new partnership. So let's look at their closing balance sheet. In order for us to know the capital contributed by each of them, Shola and Ojo, although we are told that they contributed equal amount of capital in the business, but let's try to calculate the capital contributed by each partners. So we are going to do that now. We are going to have balance sheet, closing balance sheet. The closing balance sheet of Ojo and Joke. We have the fixed assets. And we have PO'd premises. And that gives us 75,000 naira. We have features and fitting. That gives us 26,000 naira. But also, okay, that is about the fixed assets. Then we have 1, 0, 1, 0, 0, and 0. Okay, current asset now. So we have stock. The stock is 105,480. We have debtors. We have 45,000 naira. Also we have cash. Also that one is 12,000 naira, 460. I'll be 640 rather. So we can therefore add. So we have current liabilities. We have only creditor as current liabilities in the period, and the creditor is 58,940. So we have capital to be contributed by Solo and Ojo. So we can have this now. We can have this in the period. We can then have the balance in the period. So we can add all of the current assets in the period: 105,480 plus 45,000 naira plus 12,640. So we have 163,120 plus 101,000. We have 264,120. We have 264,120. So we can less the creditors from it. That will give us 58,940. That gives us 205,180. So that is the total capital contributed by Ojo and Solo and Ojo. So and when we that capital is contributed equally by them, we can divide by 2. So capital contributed by each of them is we have Solo, we have Ojo. That is 102,590. 102,590. We can add that now. That will be 205,180. So That is the capital contributed. So we know the capital contributed by each partner, that is Ojo and Solo. Now we can move to the new business now, to be able to establish the new partnership of the new balance sheet for the new partnership. Now look, we have to calculate we have to prepare evaluation account first. So evaluation account, we have the evaluation account. So now we have the evaluation account. So what is the rule? This is the evaluation of all the assets. We have freehold premises, which is now valued at 100,000 naira. This is the freehold premises. The current value now is this, and this is the old value. So what happened? There's an increase in value. And what is the rule? An increase in asset. What are we going to do with an increase in assets? So the rule states that an increase in asset valuation should be what? Should be credited to the evaluation account and debited to what? To asset account. That is the rule. We debit what? Increase in the value of assets to asset account and debit that to what? To revaluation account, and credit that to revaluation account. We debit it to asset account and credit it to revaluation account. So increase in assets, freehold premises. Increase in freehold premises. So we have 25,000 as the increments. Okay, let's do it like this. Let's do it like this. Increase in assets first. So we have freehold premises. Now here we have decrease in assets. We come to the debit side. So that is a better explanation. So freehold premises, we have 25,000 naira. Now the next thing is what? We have fixtures and fittings value at 24,000 naira, the current value, and the previous value is 26,000 naira. That is a reduction. So we are going to debit the evaluation account. So we come here. We're going to add features and fittings. So we have 2,000 naira as the reduction. So that is the reduction, 2,000 naira. Now we have stock, which is valued at 103,000 naira, but the real value is what? 105,000 for 8,000. So there is a reduction in value. Let's find the reduction. 105,480 rather minus 103,000. So we have 2,480 naira. So we have stock reduction in asset, also stock. We have 2,480. Now the next one we have okay, we don't have any other thing again. And there is no any other value of asset that is revalued. Okay, there is provision for bad debt of 3,000 naira is made. The provision that is made serves as a reduction in what? In debtors. When provision is made, you are finding what? You are reducing the balance of debtors indirectly. So that will come to the debit side of evaluation. Provision for bad debt, which is 3,000 naira. Now the next thing is capital is contributed. We've done that. Joker is to bring 80,000 naira into the business as capital. Okay, that goes to capital account. It is agreed to value and retain goodwill at 3,000 naira. It is agreed to value and retain goodwill at 30,000 naira. Now goodwill has its value as 30,000 naira. So what are we going to do? Okay, when the goodwill is being introduced into the book, we are going to debit goodwill account and credit the capital account of the partners. Okay, we are going to do that into the capital account of the partnership. Now let's balance this account now. So we are going to have, I think the total year is 25,000 naira. The total year is not up to that. So we are going to have our share of profit. This increase is more than the what reduction. Share of profit we are going to have Solo, the old partner, and Ojo. Joke cannot enjoy the share of profit since he is a new partner. So it is the existing partner that will enjoy the revaluation, the profit on revaluation. So we have this. We're going to add 2,000 naira plus 2,480 plus 3,000 naira. So we have 7,480 minus 25,000 naira. So we have 17,520. Since profit is shared equally by them, we are going to divide it by 2. So we have 8,760, and that will then give us 17,520. So if added together, that will balance the account. So the next thing is to prepare the partner's capital account. So partner's capital account, II. Partner's capital account, we have capital account. Partner's capital account. We have to maintain this. Very small. Happy partners. So partner's capital account, we have Solo, we have Ojo, the new partner Joke, we have Solo, we have Ojo, and we have Joke, the new partner. So the capital account of Ojo and that will be balance brought down. So their capital account is what? Ojo and Solo and Ojo. Their capital account, we've done that. Okay, Ojo has the capital of 102,590. That is, Solo has the capital of that. Ojo also have the same capital account, 590. So the next thing is Joke. Joke is a new partner, he doesn't have a capital. So we were told that Joke is to bring 80,000 naira into the business as capital. So when he's bringing that, he's going to bring that in form of cash. So we're going to debit capital account cash. New amount is bringing. How much is he bringing? Joke rather is bringing 80,000 naira. Is to bring 80,000 naira. So we're going to have that. So Joke is to bring 80,000 naira into the business as capital. So we've done that. Now Goodwill. You know, we told that we are going to debit Goodwill account and credit what? Capital account. And the old sharing profit, you share profit equally. So the old partner will share the Goodwill equally. They have to share this Goodwill equally. So 30,000 divided by 2, that gives us 15,000 naira. So we have to take 15,000 naira of the Goodwill, and Ojo we have to take 15,000 naira of the Goodwill. So we don't have anything here. It's the new partner. Okay. So we have that Goodwill. The next thing is the share of profit given to both Solo and Ojo. Share of profit. So we have the share of profit. Ojo has a profit of 8,760. Solo has the same share of profit. So there is nothing again. So we are not told that Goodwill should be what is to be written off. Okay, Goodwill is not to be written off. There is no information as regards to that. Goodwill is not to be written off, isn't it? We are not told that Goodwill is to be written off in the business. Okay, capital is to be computed equally. Okay, we don't have any other information. If I use the asset as follow, okay, we've done that. Okay, we don't have any other thing as regards to that. Okay, so we can balance the account. We can then balance the account. Balance the account. So we have balance carried down since we don't have anything here. Can write particular here. So we can have balance carried down. So in this we have 102 to 590 plus 15,000 naira, the amount of Goodwill plus share of profit. 760. So we now have 126,000. So we now have 126,350. So, and this also we have 102,590 plus 15,000 naira plus 8760. They still maintain the same amount of capital, 350, and this is going to give us 80,000 naira. The capital he introduced, we have 80,000 naira. So we have 126,350. So we have 126,350. So balance carry down is going to be 126,350. 126,350. Then 80,000 naira. So when brought down, this give us the balance carry down. It's the same. So we can prepare our balance sheet now. We also prepare opening balance sheet of a new partnership of Solo, Ojo, and Joke. So we can do that. Balance sheet. Okay, we can prepare our capital cash account. We are going to debit the cash account now with what? 80,000 naira. So there will be an increase in cash account. So that will be 92,000 naira 640. We are going to have 92,000 naira 640 as cash. That we are going to what? Debit our cash account. We have the cash here. We debit our cash with the amount of capital introduced. So if we have balance sheet. So we have fixed assets introduced in the period. So we have the new value of freehold premises. The new value of freehold premises is 100,000 naira. We have that. So we have 100,000 naira. So the new value of features and fittings. Is 24,000 naira. So we have 124,000 naira. Now it's current assets. So we have stock as the current assets. How much is stock? The new value of stock 103,000 naira. So we have stock. We have debtors, but provision is based on debtor already. Have debtor. I think their balance is 45,000 naira, but there's provision. There's provision 3,000 naira. So we have 42,000 naira now on debtor. Now the next thing we have cash. Cash. There's increase in cash, which is introduction of what? Capital by what? By Joke. So the capital become 92,000 naira. That will be plus 80,000 naira here. We add 80,000 naira to this. That will be 89,640. So what else do you have as an asset? I don't think we have any other thing again. Oh, Goodwill introduced. Debit Goodwill account. Goodwill then become an asset. Wow. So painful. Goodwill then become an asset. Should have added Goodwill here. Goodwill introduced 30,000 naira. So we have current asset. So we have this. Goodwill is having a debit balance on asset. So we have 103,000 plus 42,000 plus 89,640. So we have 234,640. So we have capital. We have Solo, we have Ojo, and we have Joke now. So Ojo will be 126,000 naira 350, and this one too was 126,000 naira 350 and 80,000 naira. The balance in their capital account. So we have 126,350 plus 126,350 plus 80. So we have 332,700. So you have current liabilities. So we have Creditors, there's no change in creditors. The period creditors is 58,940. What again do we have? Are we to include? Nothing again. Capital as what? Okay, nothing again. Okay, we can then balance the account. So we should have a balance account now. Since we are sure of what we did, have a balance account. So we have 32,700 plus 58,970 plus 58,970. So we have 58,940, 3,320, 332,700 plus 58,940. Then we have 391,640. So here we have 124,000 plus 30,000 naira plus 234,640. Here we have 124,000 plus 30,000 naira plus 234,640. Provision for bad debt has been fully added there, plus 248 plus 3,000 naira. Yes, minus 25,000 naira minus that, minus the answer divided by 2. Do correct. Then we have 126,500 times 2. Then plus 80,000 naira. Reduce as capital. No, what am I doing? 26,350 times 2 plus 80,000 naira. 200 plus creditors in the period, which is actually this, plus 58,940. So we have that 640. Okay, then field premises, the new balance of field premises 100,000 naira. We have that. Then features and fittings 24,000 naira. We have that. Okay, stock 103. We have that. Okay, we have 103,000 naira plus 42,000 naira plus 89,640. Okay, 640 plus 30,000 naira plus 224,000 naira. So there's an error here. We said the cash in hand, that is 12,000 naira plus the capital introduced, and that should have been 92,640. Then I wrote 89,640. That's an error. So we have 92,640. So we can add that. So you have 103,000, 42,000 naira, 92,640. And that they give us 237,640. So plus 30,000 naira within the period, plus 124,000 naira, and they give us 391,640, which is a balance account. So by treating any form of account, we should always calm ourselves. So cash in hand should have been what? 92,000 naira. So in error I wrote 89. So that's the reason why the account fails to balance. So we have a balance account now. Okay, that's. So this will be all about goodwill and revaluation accounts. So when you have a goodwill in the business, what will happen? It means the business has changed from or the business is to be acquired by what? By a new what? Purchaser. And when that occurs, what will happen? Goodwill can be bought in the book, and goodwill can be bought also in partnership once there is a change in partnership, especially when there is an admission of partners within the business. And again, we can evaluate our assets as a result of change in board of partnership within the period. So If you have any problem as regard to these topics, please play the video for a better understanding. And again, some exercises will be displayed as regard to this topic, so do well to attempt such a question. Thank you.